Price keeps falling, but the short was not late. The session forms under weekly memory. Before the 1-hour chart gives the trade, the higher time frame gives the field. Monthly, weekly, daily, then 1 hour. That order matters. If you start from the 1-hour chart only, every red candle looks like a new short. Every bounce looks like a possible long. Every wick feels urgent. You react late. You chase. You enter after distance is already gone. You hold into a target that was already visible on the weekly chart. That is where the account starts bleeding. The weekly chart must stay in memory before the daily session begins. Last week already warned about the downside path. The larger structure was moving toward meaningful weekly areas. The April 1st weekly basis box lower boundary. The March 1st weekly basis box lower boundary. The 0.33 area. Those are not small levels. They are larger memory. When price drops toward those areas, the 1-hour chart does not move in isolation. The 1-hour chart is reacting inside a bigger map. That is why the weekly review matters. Without it, the move looks sudden. With it, the pressure was already there. June 1st Asia session forms at the lower side of June 1st US session box. It also forms slightly compressed and overlapped against April 13th US session box. It does not form an open space. It forms inside old pressure. It sits low. It compresses. It overlaps. That matters. When a session forms at the lower side of another session box, buyers must prove recovery fast. If price can reclaim the box, the short weakens. If price cannot reclaim, the lower boundary becomes fragile. Now look at the box width. A wide session box gives price more room. Support and resistance are spread out. The level is wider. The reaction can travel farther. The line feels weaker. A narrow session box gives price less room. Support and resistance sit closer. Reaction comes faster. Failure appears earlier. The line feels stronger. So the trader does not look at a box as a fixed object. The trader watches the width, the location, the overlap, the old memory above and below. June 1st, Asia begins under pressure. Then price starts to move lower. It breaks below April 6th US session upper boundary. That is the first break. Price reaches the line. It does not reclaim. It continues. Distance opens. Then price moves lower again. It tests April 6th US session lower boundary. Now the downside move has a target. The short was not created after the drop. The short started when the session lost its lower side. Short entry line. June 1st Asia session lower boundary. Stop loss line. June 1st US session midpoint. Take profit line. April 6th US session upper boundary. Trailing target. April 7th US session upper boundary. Risk-reward ratio. 2.19. The entry sits at June 1st Asia session lower boundary. Why there? Because June 1st Asia forms low inside the larger session memory. The lower boundary is the line buyers must defend. If price stays above it, the session can rotate. If price loses it and cannot reclaim, sellers take control. The short begins there. Not after price has already reached April 6th. Not after the candle looks obvious. Not after the weekly move becomes visible to everyone. At the lower boundary, where the session fails, the stop sits at June 1st US session midpoint. That stop is important. The short uses the lower side of June 1st memory as pressure. If price returns to the US midpoint, the short has lost control. The market has reclaimed too much of the box. The downside idea is damaged, so the midpoint becomes the damage line. If price reaches that midpoint, the short is no longer clean. You leave. No hope, no argument, No holding because the weekly chart is bearish. The higher time frame gives pressure. The 1-hour stop still controls survival. The first target sits at April 6th U.S. session upper boundary. That target is not random. It is the first old memory below the breakdown. If price loses June 1st Asia lower boundary and keeps distance, it can travel toward April 6th U.S. memory. That is the first place to take the move seriously. Price reaches the old boundary. It reacts. It either holds or fails. Now the trade has paid enough to think about trailing. Trailing target. April 7th U.S. session upper boundary. The trail does not come from greed. It comes from distance. Price must first break through the first target area. It must not reclaim the lost memory. It must keep lower pressure live. If price reaches April 6th upper boundary and snaps back, take the result. If price holds below and distance keeps opening, the next old memory can become active. That is when April 7th U.S. upper boundary becomes the trailing target. The trail has to be earned. A useful trailing interval needs enough movement. At least about 0.5 risk-reward unit is a practical minimum. Less than that can be noise. If you trail too early, normal reaction can hit the stop. Then the trailed version earns less than the original plan. If you trail too late, the market can take back too much. So the stop follows structure. Not fear. Not greed. Not the last red candle. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot move too tight. A tight stop can kill a good trade. The price can pull back normally. It can touch the stop. Then it can continue lower without you. That pain is real. You were right. But you did not survive. That is why stop style matters. An aggressive trader can tighten the stop. The stop distance becomes smaller. Position size can become larger. Sometimes price never touches the tight stop. The trade pays faster. But the cost is lower survival. A conservative trader gives the trade more room. The stop is deeper. The position size is smaller. The trade survives more noise. But if the wider stop destroys the reward, the better answer can be no trade. The trader must choose the risk they can survive. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price keeps distance and pullback stays shallow, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not create the edge. They only manage a trade that already has structure. The structure here is clear. Higher time frame pressure was already active. June 1st Asia forms low. It overlaps old memory. It loses the lower boundary. It breaks April 6th U.S. upper boundary. It tests April 6th U.S. lower boundary. The short entry is June 1st Asia lower boundary. The stop is June 1st U.S. midpoint. The first target is April 6th U.S. upper boundary. The trailing target is April 7th U.S. upper boundary. Risk-reward ratio 2.19. The drop was not surprise. The weekly map prepared the pressure. The session line gave the trade. The old U.S. memory gave the target. That is execution. Price keeps pressing lower. But continuation still needs structure. The next session forms between old boundaries. June 2nd U.S. session forms between April 6th U.S. session lower boundary and April 7th U.S. session upper boundary. It does not form an open space. It forms inside a memory corridor. Old support is below. Old resistance is above. The market is still moving inside previous decisions. That matters. After a large drop, traders want to keep shorting. The chart looks weak. The candles are red. The higher time frame pressure is still alive. But none of that is enough. Bias is not entry. Pressure is not entry. A red candle is not entry. The next trade still needs a clean line. June 2nd U.S. session gives that line. Price first works inside the session structure. Then it moves lower. It breaks below April 7th U.S. session lower boundary. That break matters. April 7th memory fails. Price does not only touch it, it pushes through. Then price continues lower. It tests April 3rd U.S. session lower boundary. Now the downside path is clear. It is not random selling. It is movement from one old session memory to another. The short setup forms. Short entry line. June 2nd U.S. session lower boundary. Stop loss line. April 6th U.S. session lower boundary. Take profit line. April 3rd U.S. session upper boundary. Risk-reward ratio 3.06. The entry sits at June 2nd U.S. session lower boundary. Why there? Because the session formed between April 6th lower memory and April 7th upper memory. The lower boundary becomes the place sellers must break if continuation is real. If price stays inside the session box, there is no short. If price breaks below the lower boundary and cannot return, sellers control the session. That is where the trade starts. Not after price already tests April 3rd. Not after the move feels safe. The entry comes before comfort. The stop sits at April 6th U.S. session lower boundary. That stop is tied to old memory. If price breaks down from June 2nd U.S. session and then recovers above April 6th lower boundary, the short loses control. The market has reclaimed the memory that should now act as pressure. The downside breakdown is damaged. So the stop belongs there. A stop is not just a money limit. It is the line where the idea fails. If price reaches that stop, the short is no longer the same trade. You exit. No debate. No waiting for another candle. No saying the weekly chart is still bearish. The 1-hour stop decides survival. The target sits at April 3rd U.S. session upper boundary. That target connects to the next old memory below. If June 2nd U.S. lower boundary fails and April 7th lower memory fails, price can move toward April 3rd upper memory. That is the first clean destination. The target gives enough distance. The stop has structural logic. The ratio reaches 3.06. That is a cleaner continuation short. Now compare it with weak continuation trades. A weak short appears after a drop. It has a shallow stop. It has a target too close. Or the next target is too deep. The line does not fit. The trader enters because the chart looks bearish. That is not this setup. Here, the entry, stop, and target connect. Entry at active session lower boundary. Stop at reclaimed old memory. Target at next old memory. That is why the risk-reward can work. But even a clean short needs proof after entry. Price must move away from the entry. It must fail to reclaim June 2nd U.S. lower boundary. It must keep distance. If price breaks below and immediately returns, the trade weakens. If price pushes lower and pullback stays shallow, the short stays active. If reaction speeds up near April 3rd memory, protect profit. The target is not a promise. It is a planned destination. Price reaches. It reacts. It holds or fails. The trader manages. Now look at the pressure from the higher time frame again. The move already followed the weekly scenario. The decline continued toward meaningful weekly areas. April 1st weekly basis lower boundary. March 1st weekly basis lower boundary. The 0.33 area. That larger map helps explain why short continuation appears. But it does not remove risk. When price reaches larger memory, reactions can become violent. A lower time frame short can pay. Then it can snap back. That is why trailing and partial profit matter. You cannot assume a straight line. The market moves down. Then it tests. It returns. It traps late sellers. It continues only when the broken line stays broken. So the trader must manage distance. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader takes more early. 60% first. 40% left for continuation. If price keeps pressure and pullbacks stay shallow, an aggressive trader can leave more open. 40% first. 60% for continuation. If a second stage appears, structure decides again. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. Those numbers are not magic. They only change exposure. The real edge is still the structure. Where did price form? Where did it break? Where is the stop? Where is the target? Can the reward pay for the risk? In this June 2nd U.S. setup, the answer is stronger than the previous week continuation trades. The ratio is 3.06. The stop is not chosen only to force the number. The stop sits at April 6th U.S. lower boundary. The target sits at April 3rd U.S. upper boundary. The trade has room, but the execution must stay exact. If you enter late, the ratio drops. If you widen the stop, the ratio drops. If you chase after the April 7th break has already stretched, the trade becomes weaker. That is the danger. A good setup can become a bad trade if you enter late. The line matters. The timing matters. The distance matters. Now, the session behavior. June 2nd U.S. forms between April 6th and April 7th memory. Price breaks below April 7th U.S. lower boundary. It continues toward April 3rd U.S. lower boundary. The active short entry is June 2nd U.S. lower boundary. The stop is April 6th U.S. lower boundary. The first target is April 3rd U.S. upper boundary. Risk-reward ratio, 3.06. The market gives a second short. But this one is not taken just because the first short worked. That would be emotional. This one is taken because the next session gives its own structure. Each session must earn the trade again. May 31st, Asia gave 2.19. June 2nd, U.S. gives 3.06. Different session. Different entry. Different stop. Different target. Same method. Now the final lesson. If today's 1-hour movement feels difficult, step back. Monthly. Weekly. Daily. Then 1 hour. Especially the weekly chart. The daily short only makes sense when the higher time frame pressure is known. The drop into April and March weekly memory was not random. It was already part of the larger scenario. But the higher time frame does not tell you to short blindly. It tells you where the pressure is. The 1-hour session tells you where to execute. So next time price falls hard, do not ask only where it is going. Ask where the session formed. Ask which memory failed. Ask where the trade is wrong. Ask where the target sits. If the lines fit, execute. If the lines do not fit, wait. The chart can move without you. That is fine. The account only needs clean trades. June 2nd U.S. gives a clean continuation short. Price reaches. It breaks. It fails to reclaim. Distance opens. Then the trader acts.